Hello and welcome to a new edition of the weekly market dashboard. We are June 7th, 2025, and without wasting any time, we'll start by reviewing the majors. As usual, it was a quiet week overall despite the feud between Trump and Musk this week, but as you can see, the S&P is still hinching up, towards the all-time highs. We are about 1.5% away from the all-time highs. It's about similar, probably even closer on the Nasdaq. The bonds, the U.S. bonds, U.S. long-term treasuries are still struggling. 70 bips down this week again. We are reaching levels where it becomes critical in terms of interest rates. The other, I believe, notable thing, I believe it shows on the chart, is that the oil had a strong rebound this week, despite recently the Saudis have announced that they would increase their oil production. But as you know, oil is more a reflection of the expectation on the global economy. So I guess that means, and specifically when we look at the markets, equity markets as well, is that the investors are anticipating a global resolution of the trade war with tariff, and especially with China. We had a call recently, this week actually, between Xi and Trump. It was based on the trade war, but not only, it was based on the intensifying of, let's say, support of the US of country around China, specifically Taiwan, which is always an issue. Volatility ratios are, let's say, okay, within their usual range. Volume ratios as well. So the activity has definitely quite down since over the past weeks, and this is reflected in other areas of other asset classes. Here I just put the major same set of assets since the beginning of the year. Now we see that the equity indices, except the small caps that have rebounded significantly this week, which is not the other indicator that investors are expecting things to be better in the future. So these most equity indices, at least the biggest ones, are now in positive territory for the year. As I said, the bonds are still struggling, and we are still, with gold and Bitcoin, the major benefactor of the situation over this year, which is not totally surprising. So we see a regularization also on this chart when we see major equity indices relative to the S&P 500, when we see growth is leading again. With the Nasdaq, where very large caps in the Dow Jones Industrial Average is not playing the risk of asset within equities anymore, and we finally see the small caps rebounding. So again, that's a confirmation that investors are expecting much quieter times ahead. We see this very similar thing again that I've shown over the past weeks, where we have foreign equities that are not overperforming significantly the S&P 500. Germany is still leading, but if you look at the Eurostoxx 50, it's flattened. France has flattened again the S&P 500, and even the world equities ex-US have flattened. So we don't see any more money leaving the US at this time, which again is another sign of regularization of the situation. And just to confirm this, the global stocks hit a first record since February, a new high overall for the global index. We've seen that equities ex-US have been overperforming since the beginning of the year, and despite the US not being above its all-time highs, the other countries are, and globally with the US recovering, this helped the global equity index reach new all-time highs at this time. What's interesting, I was talking about the dollar before, is when the US dollar is doing well, we have overperformance of the US versus non-US equities, and when the dollar weakens, we have underperformance of the US versus foreign equities. So, and this was again, we had this in long terms when we have, let's say, between 2000 and 2008, we had a very similar situation at the beginning of this year when the US dollar was weakening, and again foreign equity indices were overperforming, like I just shown. So that's a very interesting point to note, specifically when we look at the dollar that has stopped weakening recently, but considering the one big beautiful bill that is about to be passed, and the deficit incurred by this bill, this should have an impact on the dollar. So we'll see where the dollar goes, and what in the future what we can infer on equities indices next. So again, this week overall equity indices all in the black. So again, a much quieter situation and no major divergence, which is divergences where this is where we can spot cracks in a situation. Here everything is going up, so everything looks fine. Even if you look at the equity sectors, the risk on sectors are mostly booked, where the risk of sectors are mostly sold. So again, this paint the same picture. However, on the bond side, the bonds, specifically US bonds, well, and we'll see in other parts of the world, bonds are struggling, and at some point, the rise in bond yields will have an impact on the equity markets. When, at what level, it always seems that, at least for the US, 5% seems to be the limit when for the 30-year treasuries, but 5% seems to be the limit where the equity market starts to notice, and we are in that area. So again, it's very important to stay cautious about the situation. And again, this is what I just said. This chart is showing the rise in 30-year government bonds over the past 30 days around the world. So we've seen, unsurprisingly, that Japan has seen 50 bips rise, the US have seen 30 bips rise, the UK as well, very similar, Germany, Australia, well, basically all Western, all developed countries are on the same boat at this time. At the time that actually the ECB has just lowered its interest rate. So we'll see what the market will say about that. Another interesting point is here in volatility ratios that they are basically all going down. Like I said before, maybe I can show this slightly bigger here. Is that gold and the US dollar are the most, let's say, relatively active asset at this point, and while the S&P activity and oil activity is going down, bonds activity measured by volatility ratios is going up. So that's interesting. And again, the bond market is the key to everything else. So this is the one that we still have to monitor, like milk on a stove every single time. What is this chart? This chart is what I call the risk adjusted momentum ratios, which is basically a composite of multiple momentum calculation from short-term 1 month to 1 year, divided by the volatility of the asset. And what this tells you is it gives you an indication of what many trend following or risk adjusted momentum trade followers are positioned. And we see that since the beginning of May, with the increase in momentum and reduction in volatility, the risk adjusted momentum on the S&P has recovered quite significantly from where it was, and is now on a risk adjusted basis again is leading the pack before gold and before Bitcoin. And before anyone asks me why Bitcoin is not on the top, considering over the past year it had performed, I don't remember exactly, but it's nearly 90% or 100%, I don't remember exactly. But the reason why Bitcoin is not at the top of the risk adjusted momentum is because of its volatility. Simpler, this is the asset is much more volatile than anything else, and obviously this reduces drastically its risk adjusted momentum. So we have now, based on this US large equities, S&P 500, leading the pack before gold and Bitcoin. So a couple of chart. Gold, I've seen reports over this week that gold is about to go down. I mean, at this time the uptrend is not broken anyway, so I would be cautious before calling a top and a crash in gold. We are not there yet. It can be similar to a pause that we've seen around November, December, before gold going up. And if we think again about the one big beautiful bill, I just can't get used to that name. But anyways, which will increase the debt and the deficit of the government, all the harder assets like gold, like Bitcoin, and even like equities, which is always harder than any debased fiat currency. These are some of the asset class that should benefit from that bill if it's passed. So this needs to be monitored as well. So like I said, we are seeing oil recovering. I see this more again as an indicator of investor expecting the global economy to do better in the future and needing more energy. We have the major asset classes versus gold. You see that we see again a normalization here because gold is not overperforming all asset class. There's no rush to a safe asset as this time. It's more the opposite when we see Euro Stoxx 50, S&P 500 overperforming gold. So this is a return to equities and risk on assets, confirming what I've said multiple times already. Here we have currencies since the equity markets and the risk on situation, risk on period, risk on has come back on the markets. Currencies against the US dollar have flattened. So the US dollar itself has flattened against the basket of currencies. This is UUP ETF here. And obviously you can see that as well in euro, in the Swiss franc, and the yen. So again, the impact of the next bill on the US deficit will be again very important to monitor. As we've seen, this will have an impact on the currency itself that will spill on equity markets and bond markets as well. So again, this is the key areas to monitor at this time. Last chart is Bitcoin. We hit new highs recently. There's a pullback at this time. It's not like, a crazy collapse, so I wouldn't say that the situation has changed at this time on Bitcoin. Not a very exciting week, but from what we see on the market, this is a situation where the market reassess itself, trying to figure out where to go next. And I believe that the two key to monitor over the next few weeks will be the reason of the feud between Trump and Musk, which is the one big beautiful bill we'll have again, because I say this again because this is in my opinion very important, a really big impact on the US debt going forward over the next year. You should follow my newsletter for more details about that. And the trade war with China. These are the 2 points to monitor, and that's what we will do over the next weeks. Thank you for your time. Enjoy your weekend. Bye-bye.